Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, April 21st. The stock market's behavior Monday was out of character, at least for the move we have seen off the March 6 lows. The S&P 500 started the day weak, and it got weaker as the day progressed, as there was virtually no interest in buying on the dips. It goes without question that the market was due for a pullback, but the one-way direction of Monday's trade, the sizable losses across all sectors, the inattention to good news, the heavier-than-average volume, and the rally in the Treasury market made it apparent that there was something more to it than just a simple profit-taking exercise. From our vantage point, we think the sell-off was emblematic of an important shift in investors' attitude. Before, with the market at the devilish depths of 666, it was enough to get things going that economic and earnings news was better than feared. That only gets you so far, though. In the case of the S&P 500, it looks like it got it about 30%. However, the market is becoming more demanding. It paid up on the potential for improvement. Now, if it is going to keep paying up, the potential improvement needs to be replaced with real improvement. That was the tacit message in the market's reaction to Bank of America raising its credit loss provision. To be sure, Bank of America followed a similar course taken by other banks last week, which goes to show its main shortcoming isn't just weakening credit quality, but also bad timing. Since yesterday's close, a large number of companies have reported quarterly earnings, including 6 Dow components: IBM, Coca-Cola, Caterpillar, DuPont, Merck, and United Technologies. The results have been somewhat mixed, but the market's fixation has been on the bad news. In particular, Caterpillar topped the Q1 consensus estimate by 35 cents, but issued fiscal year 2009 earnings per share guidance of approximately $1.25, which is well below the current consensus estimate of $1.77. A number of regional banks have reported results, and like their larger counterparts, they have reported good-sized jumps in their allowance for credit losses. The market opened 0.7% lower. That's not a huge move per se, but when stacked on top of yesterday's 4.3% decline, it wasn't the open one would hope for, considering the tone of the earnings reports wasn't all that dissimilar to what was heard last week when the S&P gained 1.5%. Heck, Texas Instruments even said it thinks demand is beginning to stabilize for its products. The view from Texas Instruments probably would have produced a Texas-sized jump in the averages a week or two ago, but that was then, and this is now. The new reality confronting the market is that the willingness to pay up for potential isn't as strong as it used to be, which means stocks that have had a big run off the March low will be encountering their share of resistance for the time being as they try to press higher. I'm Pat O'Hare for Briefing.com. Thanks for listening.